and assalamu alaikum everyone. So today we are starting off with, in the last lecture we have talked about the internal sources of finance like retained earnings, reduction in working capital and selling your assets as well as selling and leasing it back. So now we are starting off with the external sources of finance. In today's lecture we're going to talk about the short-term external sources of finance that are bank loans, short-term bank loans of course, but since the bank loans can be classified as short term, medium term and long term all, so we're going to talk about bank loans in just one lecture, that is today's lecture. And then in today's lecture we also talk about the other internal sources, short term external sources of finance like overdrafts and debt factoring. So without further ado, let's begin. Bank loans are relatively straightforward to arrange. This source, as it says over here, that straightforward to arrange the source of finance if the business that is seeking the credit is solvent and has a satisfactory financial history. So you all must be aware of bank loans, that okay, what are bank loans, but do keep that in mind that these are easily available for businesses that do not face liquidity problems and have a satisfactory financial history, that okay, the banks trust them, that okay, they will be able to pay the loans back after the particular period of time. So generally new businesses are not able to get bank loans. We have already discussed about that because of their lack of financial history, and they might be facing some liquidity crisis, because of which bank loans are not offered to them. So if a business does not have that liquidity problems and has satisfactory financial history, then it is relatively straightforward to get a bank loan. What it really means is that the business has to make repayment over an agreed period of time. So you borrow for a bank and you repay the bank within an agreed period of time with an interest. So whenever how much late you get, the more will be your interest rate. So it can be secured or unsecured. So there are two types of secured, unsecured loans. We have already talked about, have had a brief look over each of them, but now let's look at them in detail. Secured loans basically require security in the form of collateral, that are assets owned by the business, which the bank can sell if the business defaults on the loan, and hence recoup the money that was lent. Therefore, it is riskier for the business, but has low rate of interest. So basically, if you use secured loans you have to offer some assets that are collateral. So overall, you will have a low rate of interest, but it's riskier for you. The bank is safe because they have security. That's why it's called secured loan, because the bank have a security in the form of collateral. So they know that okay, even if the business does not pay the money, they can just sell the asset and get the money back. So the one who is in a risky situation is us, the business itself, because we have to offer the assets, so we don't have any control over that. So there's a riskier chance for us, but in the end we are getting low rate of interest as well, so that's some good benefit of that. So generally large companies like public limited companies or private limited companies, they usually get secured loans by offering their collateral, which they are assets which they are not using, so that's good for them. And unsecured loans are just the opposite, that you don't require collateral and hence it is more riskier for banks, due to which they charge a higher rate of interest. So generally small businesses like sole traders and partnerships, they don't have enough assets to offer to business. Even if they have assets, they might want to use it for themselves, so they can't just offer it to the bank, because of which they can't get secured loans. They might get unsecured loans if they have a good financial history, or perhaps they are promising, their business plan is promising, so they can get unsecured loans. But the drawback is that of course it has a higher rate of interest, so because it is riskier for banks. Secured loans was riskier for the business, unsecured loans was riskier for the bank. In this one we have lower rate of interest, unsecured loans have a higher rate of interest. Why? We have talked about that, so hopefully this concept of secured and unsecured loans is clear now. Just a bonus point over here that I added, that interest rates can also be fixed or variable. Fixed rates mean that there's more certainty that they can turn out to be expensive. They provide more certainty that okay, you already know that what's the interest rate is particular, so you can have a cash outflow, that okay, by this time if I pay this, I'll have the interest rate is fixed, so there will be so and so amount I have to pay to bank at so and so time. So you can already put that in your cash flow forecast and plan for how you can just repay it back. But they can turn out to be expensive if the loan is agreed at a high time of high interest rate. So if the interest rate was high at that particular time when you decided you will take loans, so it will be expensive if it's fixed rate, of course. But variable rates are of course not they're just the opposite of fixed rates, that they fluctuate over time because it is based on an underlying benchmark interest rate that changes periodically with the market. So it is first set up, but as the market changes it keeps changing. So whenever you have to pay it back, it depends on what is the current market situation, what is the current rate at that time, and you have to pay it accordingly. So it could be cheaper, but it could also be expensive. That it's generally lower than fixed rate, so you don't have to. Sometimes it's lower than fixed rate, so you can have it. This is risky, but there is sometimes it's risky, but yes, it is generally lower than fixed rate, so you don't have high cash outflow, but it is also unpredictable in nature and perhaps may be difficult to pay later if it turns out to be expensive. So it's not advisable. It's the market situation is very fluctuating, it's not balanced. So yeah, as we know that market is business environment is dynamic. It is business dynamism is here, so you don't have a constant environment, it will keep fluctuating. So generally banks go for fixed rate. Variable rates are there generally there for debentures or some long-term loans or credit cards basically. So we're going to talk about the debentures and all later on, but we don't need much understanding of these topics. I've just added them so you don't know that okay, there are also some fixed and variable rates, just in case you are asked in exam. So far they haven't asked it, but you know what CI is up to. Now before looking at debt factoring, let's look at overdrafts. So overdraft is not the same thing as the bank loan, that it is an arrangement by a bank to allow a business to borrow up to an agreed limit as and when it is required. You can just ask for overdraft whenever, if you have made this agreement with the bank, then you can draw as much as you want whenever you want. Of course there's a limit to that, but you can just borrow high amounts of cash inflow, not the same thing as your loans. You can borrow a high amount whenever you want it, and it can be, the advantages and disadvantages are written over here, that it can usually be arranged quickly. You can have it when you are in dire need of it, you need quick cash, you can just use for overdrafts, and it's a very flexible short-term addition of cash. Interest is paid only when overdrawn, when your cash balance, when your bank balance actually goes negative. That is when you have to pay interest, otherwise you don't have to pay interest for that. There's no need for collateral for small overdrafts as well, so generally you don't have to give assets for small overdrafts, so it's less riskier than unsecured loans. And it can be used for managing cash flow, as it allows customers more time to pay for credit purchases and can be planned for in advance. So you can use it to manage your cash flow. Generally it's used for that, to have balance your liquidity position. If you are in liquidity crisis, you just use overdraft for short-term solution. Okay, it's not a long-term solution, it's only for short-term solution, and that's one of its disadvantages, that it can be very expensive as well, often high rates of interest than traditional bank loans, high charges if an overdraft limit is exceeded. So of course when you have overdrawn, you have to pay interest. There is a rate of interest, and that is generally much higher than your traditional bank loans. You have to keep that in mind. And another disadvantage is that banks can call in overdrafts at very short notice. That means it can be recalled at any time. Perhaps you need the overdraft in the next day, but the bank say, okay, sorry, we can't offer you overdraft anymore, just some time before, and you are in a trouble now. You thought previously that okay, I could take overdraft when I am in a such situation, such trouble, but the bank just immediately called you, okay, sorry, you can't offer you overdraft anymore, we just called in, you're not, like, they're not trustworthy. There are a lot of reasons why banks do that, and we already talked about the reasons for banks not lending loans. So you can just use the similar reasons for calling in overdraft, that they might be concerned about the liquidity position of the bank, and they might be think that okay, the bank is not able to pay off its loans. It's only a short-term solution, not long-term. it may need to be secured against business assets which push them at risk. So generally, it's not, you don't need to provide collateral for small overdrafts, but for big overdrafts you need to provide assets which push them at risk. If it is used for managing cash flow, it may mean that the business is not exploiting less expensive or free short-term sources such as negotiating for trade credit with suppliers. It may mean a business is not laying a bad debt that is disincentive to chase up or recoup money on. So the last 2 points might be a little confusing for now, but we're going to look at them back when we talk about cash flow forecasting. When we say what are the benefits, when we reach the cash flow forecasting, when we decide okay we want to increase our cash inflows, then overdraft is one of those methods, and we will talk about the benefits and drawbacks of overdrafts when for managing our cash flow when we reach that point. So if you don't understand these 2 points, these 3 points right now, so hold up to that particular lecture and we'll talk about that later on. So there's no such worry for that. You can just ignore them right now as well, because you don't have to particularly learn this. It's only when examiners ask you for cash inflows. But if overdrafts, if they just ask you, you just need the basic understanding of overdraft, these 3 advantages and all those disadvantages. You don't particularly have to learn about cash flow right now. It's for the cash flow chapter in itself. Finally, we have debt factoring. Debt factoring is also used for managing your cash flows, just selling in advance. So what is debt factoring? It must be a new term for most of you, so let's see. It is basically you're selling your invoices or trade receivables to a debt factoring or third party company, which will give you immediate cash but not the full amount of the trade receivables. So when I say that trade receivables or invoices, some of you might not even be clear about what that is. So for them, it's basically that you sell your products to a customer and they will pay the payment after 30 days. So there's just a receivable over there that okay, they sign a contract that okay we will pay that to you, and that is basically your trade receivable or your invoices that after some time you will get that payment. But perhaps you need that payment now, you are in a liquidity crisis, you have some expenses that need to be paid now, you can't wait for 30 days. So in that particular case you go for debt factoring. We just sell those invoices to a company and get immediate cash. But of course, if you are selling it, the company will also want something in return, and because of which you don't get the full amount of that cash. Usually about 80 to 90% of the value of the invoice is received by the business. So that's a little disadvantage we have over here. It gives immediate cash in hand though, so you don't have to wait for customers to pay. However, it is only a short-term solution, only useful managing cash flow and liquidity. So other than that, it's not such useful source of finance. It's only for managing your short-term problems, because it will cut into profit margins in the short term as well. But if you manage your liquidity position in the short term and somehow survive, in the long term you might be able to generate profits which can cover up for these losses in profit margins in the short term. In the long term you can have good profit margins of course, but for now we are looking at it's a short term solution, and it will cut into your profit margins in the short term as well, because you're not getting that full value of your sales invoices, your trade receivables. So yeah, that's how it cuts into your profit margins. Use of debt factoring could also send a signal to stakeholders that the business has liquidity problems and hence have a negative impact on the relationship with them. So if a business is PLC, the shareholders will start selling shares believing it is no longer a good investment. So that could be riskier, and that's not a good thing. And stakeholders like banks could also stop giving them loans, and like employees might be concerned about the position of the business. Like they might be concerned that they might not be given their wages or salaries on time, or perhaps the business will eventually lose its profitability and they might be they might be made redundant. So they might just start searching for new jobs, and labor turnover might increase because of using debt factoring. But of course it won't happen immediately, but these are some consequences of what might eventually happen of using debt factoring as a source of finance. So that's all for today. Thanks for watching, and Allah Hafiz.